Morning, Stephanie.
Okay, I'll leave you alone. I know you look like you're working over there. No, I won't eat it.
You can hear me, Stephanie?
Yeah, I can hear you. Oh,
Thank you.
dear. My laptop is fell.
Okay. How do I do this again?
Now, do I look funny? Because I got a neck thing to hold my phone.
Oh,
Because otherwise I'll be holding it the whole time.
yeah. No, that's good.
Sure.
Well, I mean, it looks like you're standing up, right?
I know what I'm gonna do. I'm gonna lean it against something.
Okay.
Okay.
Oh, there it is. Okay, there we go. Mhm. Ken is on time. Early. Hi, Ken.
Morning.
Good morning. How are you doing?
Good.
Don't you
Just,
usually do your video this time?
Say again?
Don't you usually do your morning video around this time?
Yeah, I didn't do it yet, so I still have to get it done. I was trying to, I don't know why my PowerPoint's not opening. I'm trying to fix it, so.
Okay, let me let you do that.
Stephanie, you got it to work. Good job.
Yeah.
Stephanie,
Yes.
are those speakers behind you?
Oh, you can see them?
Yeah.
All right, hold on.
We're gonna say like, well,
No, I don't
it doesn't
see
matter. It doesn't
No,
matter. Just,
That's fine. That's better.
do you have to hold it though?
Yeah, that's okay.
Oh, no, don't. No, it's gonna be too long to hold it. Just put it back.
All right, let me
how you
try
have
now.
it.
No, I don't want the speakers to show.
But just maybe turn it a little bit to the right or something.
I got an idea. Hold on. This room is like all packed in. Nope, that's going to show my speakers. I'm going to hold it, Mel, because I might have to type anyway.
Oh, okay.
You know, at least I have access to.
Does it look really bad? Like, do I look like I'm not looking at the camera at all?
No.
Okay, good.
You look like you're looking right at me.
Oh, it does? Okay, good, because I'm going to read my script, so I don't have to think.
Yeah, you can't. No, I don't think you're going to be able to tell.
Okay, good. All right. Oh, what else? I saw that Mark was on, but his video is off. Let me see. Ask to start video.
Hey, I'm gonna restart my computer. I don't know why PowerPoint's not opening, so I'll be right back.
Okay. All right, bye.
Okay.
And I know. I was going to go in the other room, but. Yeah, that might
Well,
be
you have time to do whatever you want.
Oh, yeah, I think I'm going to go find another space.
Did anybody, well, this is nice and bright, so
All
And
right,
you
I'm
know
gonna
what?
put
You're
down
not
some-
going to be that big on the screen anyway, so don't worry about it.
I know, I'm probably gonna be like microscopic.
I shouldn't even have said anything.
There's like 50 people. You'll be able to see everybody, right? Because it's gonna reduce the
I'm
big
gonna,
screen.
yeah, I'm gonna be able to see everybody.
Okay, I think I can go right here in my kitchen.
Well, just make sure you're
I-
able to sit down and not have to hold it. That's the
Yeah, I'm gonna lean it up. I'm gonna sit on my table and lean it up, but I'm gonna lock my door so nobody walks in and uh, makes noise. The only one that's here is Julie. She knows I'm on, so.
Got 'em? Okay, just fold them up for me. Or I'll help you right now with the folding.
Jaylee, I'll be on the kitchen table, so be quiet if you come out, okay? All right, thanks. How's that? Better?
Perfect. So did anybody else sign up this morning or no?
No, I've been refreshing. That's why I wanted to stay in there. But I'll refresh I'll wait 5 minutes and I'll refresh again.
Okay.
I invited some little last minute
The
people.
office manager.
Good
Hey,
morning.
Mel.
Aw, you look so pretty.
Oh, look at her.
You're lucky I made it. I almost burned some pancakes this morning.
Oh, pancake sounds like a luxury item.
I was trying to be fancy and do like oatmeal pancakes and all that healthy, whatever. And they came out really bad.
Aw.
So I just had to
Never
drink.
do that.
I don't know what's up with Mark. I don't see his.
So how do we know, Mel, once they start joining? Like they're gonna, like the people.
Put up your chat. Do you have your chat up?
Wait, that's true. Hold on.
Yeah.
Let me make this
Also
big.
for our chat. Because then I'll be able to see whether you can see attendees or not.
Okay, it just says Zoom webinar chat, and then it says send the message to all panelists. All panelists and attendees, Melissa, Stephanie, and Mark.
Okay. Interesting. Well, let me type something in and see if you can see it.
Good morning, Mark.
Oh, good morning, Mark. Oh, wait, let me unmute Mark. Okay, good morning, Mark. How are you doing?
That too.
Good. Let me see here.
Oh, Mel, it does say participants at the bottom, and it has 4. So maybe that's how we'll see it?
Yeah, you don't see anything that says attendees?
Oh, yes. Okay. So if you click participants, it brings up panelists and attendees.
Okay,
So far, 0.
Okay, perfect. Yeah, nobody can join until I press broadcast.
Oh, okay. Okay, that's cool. Hi, James.
Hey, how you doing?
Oh, Mark is muted again.
I think he did that on purpose, maybe.
Oh,
You know, Mark.
I know.
You hear me?
Yes, now we hear you.
Mark.
Okay.
Thanks, James. Are you at the office or home, Mark?
I'm home.
Oh,
I tried to find a room to, I don't have an office at home.
oh, really? Okay.
Yeah.
Wow, I'm surprised because you're such a workaholic.
I go in.
I know, that's true.
I go in on Saturdays.
Yeah.
Good morning, Mr. Ken.
Morning. Okay, we're good.
All right, we're all here.
Oh, Mark, were you able to get your PowerPoint presentation?
Yeah, can I try it real quick?
Yeah, please.
How do I do it here?
Down at the bottom where it says share screen.
Oh, share screen. Okay. Can you see that?
Yep.
Yeah.
You see that? Does it look fine?
Yeah, well, at the bottom, right at the bottom right, there's the next one to the right. The 2 to the right. Your other right. Okay, there you go.
There you go.
There you go. That's what you're gonna do.
Everybody clap for Mark.
Yay!
My dog wants to say hi too.
What kind of dog?
A pit bull.
Oh, where's my
Let's see,
girl?
let's see, 1 minute. There's one.
Oh my goodness. Hold on, wait. Let me make you big because I see you're really small. Hold on. How do I do that? Oh, I can't. I
Piper,
can't.
come here. Piper, come here.
That's two dogs.
Oh,
Her name is Piper?
This one's Luna, and her sister is right here. There's another one here.
I was gonna name my dog
my
Luna.
gosh. Wow.
oh.
Aw. So
Sisters.
I can't lift up my dog. She's too fat.
is
She's
that a
60
bulldog?
pounds.
Right, get out of here.
Mia, come. Mia, come. Ven. But she knows Spanish and English, guys, okay?
Oh, really? Wow.
Mia. Ven, ven.
Instead of magic, you're gonna go with puppies, Mark?
No,
Is
I
that
can't.
the,
She wants
is
to
that
play
the
with me and I can't.
No, I gotta put him outside.
She doesn't listen.
No, I'm gonna put her in the room now
Oh,
in a little bit. Or I should,
Hey,
yeah.
what is that?
your dog, I think, is pink. Isn't it pink, Maria?
No, she's like caramelish, like light brownish, kind of.
Oh,
Like a dirty blonde.
oh, okay. Where's Stephanie? Stephanie?
Still there?
Oh, can you call Chris and ask him if he's up?
Oh, that's right.
Okay.
And I don't know where my girls are. Wait, let me call.
I'll call them.
Oh my God. I'm gonna go ahead and broadcast. Mark, I'm gonna take, oh, there's Nadia. I'm gonna take back control here. Let me see, how do I do this?
I'm
No,
gonna
I'm
stop
gonna
my
call Brenda.
share.
Yeah, stop your share. Mm-hmm. Good, good, very good. All right, so unmute. Welcome, Nadia. Nadia, you there?
Yes, yes, yes.
Oh, okay, okay.
Let's go. Come on. Luna, come here. Come here. Luna, come on.
Brenda's almost connecting. She's putting on her earrings. Hi, Nadia. Good morning.
Morning. How are
Nadia.
you?
Good. How are you?
I'm good.
Ken, Nadia is at Madeline and
Well, I'm in the
Kevin's
car.
future house. Well, how did
Oh,
that go?
right.
Oh wait, are we live yet? I don't want to be talking about that and then.
No, but I'm about to press live in a minute. I just wanted to try and see if Brenda would sign in first.
Okay.
I don't know where Chris is. What did he say, Steph?
I didn't get him. I'm gonna text him right now.
Oh, okay. All right, I'm gonna have to press broadcast. Let me give it one more minute. Nadia,
Oh, she's muted.
Nadia? Oh, maybe she muted herself. I just want to let them know they don't have to say anything. You heard me, Nadia? Because I know you're showing a house. Uh-oh, she's permanently muted. Okay, I'm gonna go live. I'm not gonna talk until.
Maria, you got your laptop up? Oh, never mind. Here it goes.
Yeah. No attendees yet. FYI. Oh, one.
One. I'll probably give it until 10:30. So I see one person.
Three.
I don't see their names. Almisha Phillips, welcome.
Welcome, everybody.
Guys. If you can hear us, just put in the chat that you can hear us. You want to make sure that you can hear us. Oh, perfect. Thank you for saying that you hear us. Thank you, Ken. And we are going to be getting started on time, so. Maria, you see the chat, right?
Yes, I just responded.
That's outside, just out in the hall.
FYI, Brenda's as an attendee.
Oh, she signed in as an attendee. Oh God.
We'll check to see if you added her as a panelist.
Yeah, I can't do that right now because people are logging in and I'm about to start.
Okay.
Ms. Melrose? Yes, ma'am. No problem. Good morning. I'm fine. How are you? I'll have Stephanie send it to you. Stephanie, send the link to Melrose.
Okay.
We're actually starting the event right now, so she's going to send you the link. Stephanie?
Yep, I'm gonna send it.
All right, then, thanks. You froze, Stephanie. Welcome. I see people coming in.
Yes, welcome everybody.
People are walking in, so we're going to give it a couple minutes before we get started. As you come in, please check for the chat. Make sure your chat is up because we want to make sure that if you have any questions that we can see your questions and have them answered. Stephanie, maybe you should send the link to Brenda so that she can she can log in on the right link.
Okay.
Welcome, Mrs. Ocasio. Hi, Diane.
For everyone that's coming in, I'm just letting you know that we're just giving people some time to come in and then we're going to get started shortly. Are we sure that Chris has the link?
Yes, because he confirmed it back to me.
It,
And the link changed and I said, yes, it did.
okay. All right.
Remember, I have to go to the appointment, so.
Yes. You're not going to have to speak, Nadia, just so you know. We just want everybody to see your lovely face. Okay.
Okay.
All right. So just do a quick good morning so that we can see that you are able to hear us, for those that haven't done that already. Okay, so we are going to get started. So good morning, everyone. Welcome to the Homebuyer Seminar. As you come in, I see some more people coming in. Just do a good morning in the chat so we know that you're all here with us. So for those that don't know me, I am Melissa Miller of the Melissa Miller Group with eXp Realty. And this morning I'm here at our office here in Weston. And I would like to thank all of you for attending today. We have some great speakers on the panel, and we know that you're going to leave here with some really, really great information about the real estate process, about your credit, and about so much more. So we're quite excited for you to be joining us today. Now, I just want to mention, as more people are coming in, some lucky attendees will be winning some of our door prizes. We do have gift cards to give away from our sponsors, our partners. So we're looking forward to giving those away at the end of our session. And everyone will be receiving a voucher, as we said in our ad, $500 credit towards closing costs. And that's one per home, one per purchase. And that's for when you're using our team and our partners. And you know, that's awesome that we have great partners to work with. So also, each attendee will get in an email on Monday our handy guide entitled Things to Consider When Buying a Home, with a lot of really great real estate information. So everyone is a winner today. When you leave here on Monday, you will be getting a voucher for $500. Hopefully, you'll be one of the lucky ones to get the gift card, and also the handy guide, Things to Consider When Buying a Home. So as I said, we have a great lineup, and usually we have the seminars in Weston, and now for the first time, we are pleased to bring our seminar to you virtually, which is already a big success. I think we're already at more participants than we've had live. So we're happy that we're able to come to you in your homes today. So make sure you have a pen and paper and get ready to take notes. And as I said, we're monitoring the chat for questions. So as you think of questions, go ahead and type them in. And when the speaker is done with their presentation, we will have a question and answer period, okay? Now I'm gonna take a quick moment to introduce my team. And working with a team is very beneficial because we have someone that specializes in every phase of the real estate process for you. So first we have Maria Machado, who's our office manager. And
hello, everybody. Good morning.
Processor. And then we have Stephanie Baptista, our administrative assistant and marketing coordinator. Say hi, Stephanie.
I think the screen froze.
Her screen.
Oh, there we go.
Oh, there she goes.
Good morning.
Next, we have Brenda Miller, which is our listing and buyer specialist. And also we have Nadia Thomas as our buyer specialist, joining us on the road. She's on the road today, working with clients, working hard. So, so thank you all. And together, we're the top real estate team. We service all of Miami-Dade, Broward, and Palm Beach. And we're here to help you not just become a homeowner now, but we are your real estate team for life. So now we're gonna just introduce some of our panelists. We have Ken Zorvitz with Priority Lending. Hi, Ken. We have Chris Colston with Second Chance Credit, as well as Mark Bookstein of Title Guarantee of South Florida. We're gonna be hearing from some top leaders of our industry today, and we're very happy to have them. So thank you guys for taking the time out on Saturday to be with us. We appreciate that. So we will begin the session, and I'm going to basically do a brief overview of the market. I really want to just set the foundation for our meeting today, especially in the light of times that we're in right now. So give me a moment. I'm going to be sharing my screen. Okay. Okay. All right, I'm not. Okay. Everybody can see my screen? Maria, you see it?
Yes.
Okay, good, good. All right, great. So the question that's on everyone's mind right now, there's several questions. When is the economy going to recover? Are we going into a recession? Is this going to be like 2008? and what should I do right now? Now, some of our panelists are also going to be going into, touching this a little bit as well. But like I said, I wanted to just set the foundation because if you're here and you're considering buying real estate, I'm sure there's concerns. Should we buy now in this economy? And are we ever going to recover? Is it like the market crash from before? So let's get started with that. Next screen here. When is the economy going to recover? So, so much has happened in the last couple months, and we've all been affected in one way or the other. We're getting so many questions. We're getting so many questions about the pandemic and whether it'll cause a housing crash. Now, no one has a crystal ball to guarantee what will happen, but there are some key indicators that give us clues as to what direction the market will be heading in the coming months. And that's what I'm going to go over with you right now. I really want you to have a sense of confidence of where we're going and just to be able to answer some questions that might be on your mind. So the next slide. So we've done some research, and we got the forecast from all the leading financial institutions, Goldman Sachs, JP Morgan, and Morgan Stanley, and they're all pretty much saying the same thing. The rapid decline in activity that we've seen over the past couple of months will be the same rapid incline through the rest of the year. We're gonna have what they call a V-type recovery, strong down and strong up, which we are already starting to see that trend back for recovery. Now, just so you know, starting out in January and February of this year, we had more houses sold in this country than any other January and February in more than a decade. So we were on that trend, and then bam, everything just slowed down because of the pandemic. So we were doing very, very well. So the next slide. Are we going into a recession? Now, one thing that I want to just make clear is that a recession does not necessarily indicate a housing crisis. And many people think that it does. But there's been over 47 recessions in the US. And with the exception of, and I'm going to the next slide, with the exception of the Great Recession from 2007 to 2009, which is what we call the market crash, and the Gulf War recession from 1990, from 1990 to 91, no other recession has impacted the US housing market, according to Freddie Mac's data. So that's good news. Now, the next slide. Is this going to be like 2008? And, many, still expect the housing market to follow a similar trajectory in response to the corona outbreak, but there are distinct differences that indicate the housing market may follow a much different path. While housing led the recession in 2008 and 2009, this time it may be poised to bring us out of it. And I want to give you a little indication of what we were dealing with before. 6 years leading up to the housing crash, as you can see on the right side, hopefully you can see my cursor here. The 6 years leading up to the housing crash, the market was just out of control. It was like the Wild West. The last 6 years leading up to this pandemic, you can see here, the appreciation was much more stable. So that's why people are looking at this and saying, this is a different time that we're dealing with, much more conservative time, especially for the mortgage industry, and compared to the 6 years leading up to the housing crash. Okay, next screen. And as you can see here, and of course, Ken can speak on this a lot more than I can, but back here, if you look at 2004 to 2008, this was the availability for mortgage credit. Basically, as far as I know, back in that time, if you could fog up a mirror, you could get a mortgage. I mean, it was just really, really easy to get a mortgage back then. People that didn't have jobs but had high credit, they could qualify with no income, no assets. Now, if you come to today, we're talking about a much more conservative time when it comes to mortgages and being able to get a mortgage. The guidelines are much more, they have very strict guidelines. And it's just a better, more conservative time. So, when you have these kind of numbers back during the mortgage crash, where people were getting a mortgage and they couldn't afford it, that's what led to the deluge of foreclosures and just a very unstable market compared to today. So the next slide. The other difference is that we had almost 8 months of inventory going into the market crash. So we were already slow with being able to sell homes. So now we had very low inventory going into this pandemic, 3 months of inventory, which is well below what is considered stable. A stable inventory would be around 6 months. So we're very low. So homes are still being sold. Buyers are still purchasing. We've had a pause, like I said in the beginning, we've had a pause on the activity, the huge activity that we had at the beginning of the year, but it has not stopped, that's for sure. Next slide. One thing to look at, as far as a lot of people are worried, so many people are losing their jobs, but if you look here, and this is as of March data, if you look here, you will see that over 59% of those that filed for unemployment is in the food services and drinking places or bar industry. So that's a good sign, because once the restaurants open back up, all of them are going back to work. And, after 2-3 months of, dealing with our children at home, of course, the child care workers are gonna be going back to work. We'll probably pay them double if we have to. So accommodation industry, hotels, they're all going back to work, construction workers. So this is what I mean by things are on a pause right now. So all of these people will be going back to work and things will be eventually getting back to normal. Now, what should you do right now? Now, one thing that I want to say is that home ownership is definitely the key to, just skip my screen, sorry, to wealth creation and enabling current homeowners and succeeding generations to move up the economic ladder. So the other question that I have that I get is, where can I find the foreclosures? Where can I find the short sales? And I just want to show you a comparison of after the market crash to now. Back before the market crashed, we saw huge inventory, and then it was compounded by the fact that so many people went into foreclosure. Over 35% of the distressed property sales were foreclosures. Now, if you look on the right side of the chart, we're down to 2%. So that's one indicator that we can just build our confidence about purchasing in the real estate market. Not only is it good for investment purposes and building wealth for yourself and your generations, it's you know, it's also a place for you to live, right? So it's important that if someone needs housing, we also want to indicate that uh, rentals are increasing, rental prices. So when you say what should you do now, the ideal thing would be for you to purchase a home, and especially for those that are in leases, to invest in yourself instead of your landlord. So the other thing that I want to show you is buyer demand. This chart here does show you nationwide what we're looking at, especially here in Florida. In Florida, we're looking at a very strong buyer traffic. And because of that, Florida was also ranked #1 for relocations. Florida is one of the most desirable places to live. We have the good weather, we have large industries moving in, and it's very attractive to businesses because we have no state income tax. So as far as the stability of Florida, the desirability of Southeast Florida especially, that desirability has just been helping the market remain strong. The next slide is regarding interest rates, and Ken is going to go into this a lot more, but what we see here is just from 2016, just a continual, if you look here at the bottom, you just see the interest rates just have remained low compared to, you know, the 80s and the early 90s when we had double-digit interest rates of 12% and up. We are just looking at historically very low interest rates. So those are a few of the things that I just wanted to show you as far as the market. And I lost my chat. So Maria, do you hear me?
Yes.
Oh, okay. So I don't know if any questions are coming in, but that's just an overview of the market that I wanted to give you this morning. And then also, as far as how to proceed with purchasing a home, and I don't know why this won't stay. We're also going to be sending you this chart just to give you an idea of the process for when you're purchasing real estate. So we will send this to you in your email as well. But this is why you have us as your real estate team, because we do walk you through the whole process and make sure that you know what the next step is. But your first thing that you're going to want to do is to give us a call so that we can have a more personalized consultation with you. We're doing a lot of virtual consultations now to sit down to come up with a plan so that you know exactly what steps to take, whether you're thinking about buying now or whether you're thinking about buying a year from now. So what we also encourage our clients to do is to get pre-approved. And, you know, this is where Ken is we're going to let Ken take over on this, but getting pre-approved really is the key to knowing what steps you need to take to get prepared. Because even if you think you're ready now, there might be some things that can be done to help you get into the best position for purchasing. So that leads me into the segue with Ken. I just want to introduce Ken Zorovich from Priority Lending. And Ken Zorovich is the vice president and a leading mortgage lender, and he has worked with many of our clients to achieve their dream of home ownership. So Ken, I am going to turn it over to you now.
Excellent. Thank you, Melissa. And that was really interesting information. I didn't know a lot of that stuff about the unemployment and all that. That's all positive. I love hearing positive stuff about our market right now, because if you turn on the news right now, you'll hear plenty of negative stuff. So
Right.
Appreciate you sharing that. And first of all, let me just thank you and your team for doing this. I mean, listen, I have the privilege of working with a number of agents out there. No one else is doing stuff like this and embracing the technology, wanting to get the word out there, wanting to get the message out there. So thank you for doing this and being a leader in our industry. So
Thank you for saying that, Ken. Appreciate it. So Ken, I think you froze a little bit. So while he thaws out, we'll.
and I apologize. Seems to be having an issue right now.
Okay.
About to talk, it's going to have an issue here.
Okay. All right, we'll wait for you to thaw out.
Can
So
you guys hear me okay?
yes, I can hear you fine.
Okay.
Oh, there you go.
All right. There we go.
Yes.
It seemed like it was freezing some on my side. So let's dive into this.
Mhm.
And I think this will be some good information for everyone here. So let me try and do this.
And while you're getting set up, Maria, did we have any questions that I could answer right now?
Yes, we have a question from Alicia Beckford. Hi, Alicia. She was asking, do you think the requirements are going to be more challenging with the pandemic?
Awesome. Well, that's an awesome way to segue into Ken's presentation, because
Yes.
he's the expert and he's definitely going to answer that question. So thank you for that. We'll have that answered soon.
Okay, so how do I? Give me 1 second here.
Melissa.
Okay.
Check your cell phone.
Okay.
Can you guys see the screen okay? Is this coming through okay, Maria?
Yeah.
Mm-hmm. Yes.
Awesome. All right, so once again, Ken Zorbridge, Priority Lending. What I want to accomplish today is to help you understand a little bit about the market, what it takes to buy real estate, and leave you with a lot of information so that moving forward, you'll have a better idea of what you need to be doing. Because the best thing about real estate, or the most effective way to purchase real estate, is to have a plan, and that's what we're going to help you with. So, okay, so what is priority lending? How are we different from maybe a bank? What's a broker? What's a lender? You hear all of these terms out there about places you can get a mortgage. And what you really want to understand is there's several areas in our marketplace you can get a mortgage. Okay, and it's called the origination level. Okay, there's direct lenders, which is what we are. Okay, that means that we lend our own money, and we're also a seller servicer, which means that we sell loans direct to Fannie Mae, Freddie Mac, and Ginnie Mae. Okay, what you want to understand is these three entities are the ones that buy mortgages out there in the marketplace, and they create the underwriting guidelines we all use to go off of. So whether you go to the biggest banks out there or you go to us, we're all selling our loans off. Okay, now servicing means that we have the ability to service, and everyone thinks that just because they're paying their payment to someone, that's who owns it. No, these three players are the ones that own it. A broker has to go to someone like us who has the ability to get their loan to Fannie Mae and Freddie Mac, because brokers can't sell direct. And that's the key thing. The closer you are to selling to Fannie Mae and Freddie Mac, the more aggressive you can become with their underwriting guidelines. The reality is that underwriting guidelines are very aggressive for mortgages. It might not seem that way at any given time or in this market right now, and that's because we still carry a lot of liability even though we're selling the loan off. So banks and anyone, direct lenders, anyone who lends their own money, they decide how aggressive they want to be given everything that's going on in our market. So I've seen a lot of things in the news where banks are putting out information of, hey, we want 20% down and a 750 or above credit score. That's just what that bank wants. That doesn't mean that's what the market is doing. And unfortunately, that bank just has a loud voice because they're very big and popular. But the reality is lending is very aggressive right now in many areas. Okay, so here's where I think we differentiate ourselves from other places, is that we don't necessarily deny borrowers for a loan. When someone comes to us to get pre-approved, we are literally trying to pre-approve them, or we're giving them a path to pre-approval, okay? A roadmap to get there. And what's great about going through this process is that you may find that you are 2 months away, 6 months away, maybe you are a year away, but the benefit of that is knowing. The worst part in all of this for most people is not knowing or assuming they're not going to qualify, and then afraid that I might just confirm their fears. But I always find that even when I tell someone something they don't want to hear, by the time they leave our office, they feel so much better because at least they know where they stand. And that's the key thing in all of this. And we will tell you how to get to that finish line and work with you along the way. All right, so you'll hear these two terms in the marketplace, pre-qualify and pre-approval. Here's what you want to understand about it. Pre-qualify means a buyer submitted their application and had their credit pulled, okay? That can give us a preview of what they can get approved for, but it lacks the integrity of being able to review their income and assets. Because if you're not calculating your income the way the industry does, you may be putting in, inaccurate information into your application. So I might be able to get and say, oh, wow, you make this money or you have this much money. Great, you can get qualified. It's a quick way to maybe get some initial feedback to a client, but it's not as strong as the next one, which is a pre-approval. A pre-approval means you've given us an application, we pulled credit, we've reviewed income and asset documents, okay? The reason why this is so important is because you want to know with confidence you're not going to get denied for a loan. And here's the amazing thing about our industry. Our industry does not discriminate, okay? And what I mean by that is you could have the highest credit score, you can make tons of money, and you could have tons of money saved up, and you still may not be able to qualify for a loan. And why is that? And it's just because there could be nuances of underwriting that you just don't fit into with the way your loan's being submitted. And so we have to be loan technicians to help figure that out. Okay, so don't ever assume that you're just going to be a slam dunk to qualify, because I can give you examples of clients who thought they were slam dunks and ended up having issues, but we were able to get through them and figure them out. So getting that pre-approval up front will make you a more confident buyer. It'll make you a more targeted buyer, so that when you go see a property, you're going to be able to walk into it and say, wow, I really love this layout. I love how the backyard is. I can see our kids playing over here. I can see cooking in here and watching this. That's what we want. We don't want you to walk in and be like, we really like this place, but can we afford it? We have no clue. Should we even be shopping here, right? So once you understand your numbers through a pre-approval, you will be assertive. When it comes time to contract, you're going to say, Melissa, yes, go get this place. Here's the price. Let's make it happen. Like, that is such a, to me, that is being more offensive when you're shopping than defensive and worried about making an offer. And you're going to get there by understanding numbers. Okay, so here's what you want to understand about the 3 loan types that are out there. These are the most common types. There are some others, jumbo loans that are available and some what we call portfolio loans, but these are the most common types. FHA. FHA, what makes it unique is it's a government insured loan. It allows for minimum down payments, and it also allows for the highest debt to income ratios. Okay, oftentimes people think of this as the first-time home buyer loan. It's really not, but it is a loan that a lot of first-time home buyers use and get qualified for. It's a great loan, okay, but it's not technically the first-time home buyer loan. Next is conventional. Conventional is what I call a true free market loan. It is the most popular loan in our marketplace. What makes it unique is instead of being insured by the government, it's insured by private companies, okay? And since it's insured by private companies, what ends up happening or how this loan tends to be more conservative is because what can happen to insurance companies in economic downturn like 2008, insurance companies can go out of business, right? FHA takes more liberties in their underwriting because investors assume the government's not going to go out of business, okay? So they're always going to be there to insure the loans. So that's why conventional could ask for higher credit scores, lower debt to income ratios, and try and be a little bit more conservative in some areas. Other areas, they're more aggressive than FHA, but that's the true difference between them. VA loans. This is reserved for our military people who have served. These are amazing loans. We do a ton of them. Really what you want to understand about this is as long as a veteran has the ability to qualify for the loan, then they are, the underwriting guidelines are set for to really help them qualify. I think what people miss out a lot of times on the VA loans is they think that either one, they may not be able to get into it even though they have the benefits, or two, they don't fully understand it and how it works. So we spend a lot of time educating both our clients and realtors on it, on why they don't need to be worried if a seller takes a VA loan offer, because they're to me the easiest loans to get qualified. So, okay, credit. Chris is probably going to dive into this a little bit more, but I'll tell you on the basis of what you want to understand about credit when it comes to applying for a mortgage. This is one of the 3 pillars of qualifying. You have credit, you have income, and you have assets, okay? Those are the 3 pillars for your pre-approval. All right, now depending on the loan type, there may be credit score requirements. So in a normal marketplace, FHA requires at least a 580 credit score. Now, what you're seeing right now in our marketplace is those FHA loans for those lower credit scores are very, very hard to come by in the market. And that's because certain scores have a historical data to back up that they could go into delinquency or default. Okay, so right now what our market is doing, or our industry is doing relative to what's happening with COVID, is they're trying to eliminate or suspend higher risk loans because of the uncertainty of existing delinquencies coming on loans that are out there, right? So that's where we're pivoting a bit. So normally it's 580, right now it's about a 620. Okay, so that shows you the difference. The reality is, even if you're in that 580 to 620 space, it may be extremely costly to get that loan. So you might as well work on your credit to try and get it higher to make it more affordable. Now, conventional's minimum score is a 620. But the higher you go with a conventional credit score, or I'm sorry, the higher your credit score goes with a conventional loan, the better the loan will be for you. Interest rate will be better. Mortgage insurance, if you have it, will be cheaper. So there's a lot of benefits to increasing your score there. VA technically doesn't have a score requirement. However, you will find, because as a direct lender, we lend the money, VA just insures it. So VA may say they don't have a credit score requirement, but the industry does. We will look for usually 580 and above on VA loans. So just kind of plan on that. I get this question a lot about collections, charge-offs, things like that. What you want to understand is these are not, life sentences, okay, where you're not going to be able to qualify for a mortgage. These can be on your credit and you still can qualify. There could be some benefits to increasing your score if you address some of these. So someone like Chris would be a good person to talk to on that if we thought, hey, if you did this, this, or this, you might be able to increase your score. So just keep in mind, though, that it doesn't mean, a lot of times people are like, oh, gosh, I'll never qualify. I know I have collections. I just don't even want to see them to think about it. Don't worry. Let us take a look. It may not be as bad as you think. Then finally, foreclosures, bankruptcies, short sales, okay? These are all things that have happened to people before in the past. If you had a home in 2008 or 9, perhaps you experienced some of this. It happened to a ton of people. But what you want to understand is, once again, it's not a life sentence. It doesn't mean you can't get back into the game. There are waiting periods, but it doesn't mean that you'll never be a homeowner again. So we can go through and talk to you about what are the seasoning requirements, which is how long has it been since this last occurrence, to show you how you can get back into the game. And there's a lot of loans, especially FHA is probably the most lenient. VA for veterans is very lenient on it. So there are ways to get back into the industry. Into home buying after that. Okay, income. Depending on how you make money will depend on the type of documentation you need. Okay, so if you're a W-2 employee, you work for a company, you get your W-2 every year. Very simple, we're gonna go up W-2s, pay stubs, and probably a verification of employment, okay? Self-employed, for those my business owners, the most common theme I hear from business owners is, listen, I write off everything because I don't want to get taxed come April. Well, guess what? When it comes to mortgages, we can only go off of what you report. Okay, so yes, writing everything off is good, you know, tax time, it's not good mortgage time. So what we generally look for is 2 years of tax returns. We're going to average the income you report over that 2-year period down to a monthly amount, and we're going to use that for qualifying. For some people, if you've had your business open for 5 years or more, you could qualify for 1 year of tax returns. This is a great option for self-employed people because it could be your best year, most recent, and that could give you more purchasing power when it comes time to apply. Now listen, in normal market situations, we also have unique options for other income types. Asset depletion. This is a great option for people either of retirement age, where they have a lot of assets built up, or just someone in general that has a bunch of assets. There's a way we can use some of that as income. Retirement income is stuff that we can easily use. There's even bank statement loans that have been out there in our marketplace for years. They've just been kind of furloughed or suspended right now because of the uncertainty of what's going to happen in the marketplace. So some of the more exotic income loans that are out there have kind of been tabled right now. But overall, lending is still in a good spot and acting as normal right now. So, okay, assets. So this is another one that we get a question about a lot, or that people need a good understanding of. And it starts right up front with, how much money do I really need to buy a place? I hear that I need 3% down. Does that mean I just need 3%? Or I need 3.5%? Or, you know, can I borrow money from here to get the money? So here's what you want to understand about assets. First of all, the total amount you need at a minimum is about 7.5% of your purchase price. Use that as a basis right now. It might be a little bit more, it might be a little bit less depending on your price point, but this is a good basis for you to go off of right now. So if you have a price point in mind you want, take that price point, multiply it by 7.5%, and plan on needing at least that amount of money, okay? That's something that you can work with, and you know that you can get into a property at that amount. So where can this money come from? Simple things, checking and savings, correct? 401ks, okay? Retirement funds, there's ways to take loans against retirement accounts. There's ways to potentially liquidate some. So you have some options there. And then finally, gifts, okay? Gifts from a family member. And here's what you want to understand about gifts. I get this question.
Let's give it a minute for Ken to thaw out.
Doesn't, they do not care about, okay? Anything over 14.
Ken.
IRS is interested in.
Ken?
Okay. In that, but they're not going to start taxing you until you would get $5 million from a relative.
Ken, I don't know if you can hear me, but if you can just go over that section about gift funds again, just repeat that.
Am I still on here?
Yeah, you are, but Ken, can you hear me? Everybody else is still okay, right? Oh,
Yes.
so we're just gonna give Ken oh, there's Ken. Okay, Ken, let me unmute you. You're there. Oh, Ken, you just went out a little bit when you were talking about gift funds. So if you can just.
Oh, okay. So it wasn't from the beginning then. It wasn't from the start. So.
Yeah, no. We
From
right
the gifts.
gift funds, which is very important. We want to know about that.
Yes. So gift funds. Okay, gift funds can come from family members only. Okay, can't come from friends, coworkers, employers, things like that. Family members only.
What about
now, there are no IRS tax implications on anything under 14,000, and anything above 14,000, the IRS will only tax you on once you would get to 5 million. So there's really not much that many people have to worry about when it comes to the gift from family members. Okay, and then finally, assets that are not acceptable. Okay, cash we cannot accept because we have to source money for money laundering reasons and all of that. So cash we cannot use. There are ways to get around it if you have cash somewhere saved up, which we can, kind of talk about. Credit card advances, can't get any credit card advances and try and use that money for closing. And then finally, gifts from friends, like I talked about, it can only come from family members. So anything that goes into the account that you can't source has to sit for at least 60 days before you can even use it for closing. So there are options that we can talk about, but I think it's as simple as just sticking with the acceptable sources for right now. So, all right. So that's what I've got for you guys on the 3 different pillars that it takes to get qualified. Here's what I would want to just end with here on what's happening in the marketplace relative to interest rates and that type of stuff. So right now, interest rates are very low. Okay, so there's a lot of opportunity for people in the marketplace. Now, people are worried about, can I qualify in this environment? And the answer is yes, you can. The biggest question or the biggest adjustment we've made in this marketplace is, will your job continue? Okay, are you going to continue having a job? Will your employer lay you off? If your employer has no intention of laying you off, if your job is not in question, you should not have an issue qualifying for a mortgage, because that has been the biggest change so far. Okay, so as long as we can prove that, you should be good to go. I think that rates will be down for most of this year, despite us opening back up at some point. I think the market is going to be a little bit slower to catch up that way, you know, the stock market and everything, because they're going to want to see how everything plays out, that we're not going to go back to being in quarantine. So I think rates will be low for a little while. So this will be a great window of opportunity for people. And I think mortgage lending will continue to be out there and available. So now could be a great time for people to get into the market for sure. And that's what I've got. Any questions?
Okay, so Maria, we have any questions for Ken?
Yes, we have a question from Caesar Johnson. He's asking entities, Freddie Mac, Fannie Mae. I'm not sure.
So he probably wants to know what's the difference between
The difference?
Freddie Mac. Just clarify, Caesar, but I'll ask Ken to just explain a little bit about Fannie Mae and Freddie Mac for now.
Yes. So Fannie Mae, Freddie Mac, and Ginnie Mae are the 3 players. Okay, Ginnie Mae purchases only FHA and VA loans. Okay, Fannie Mae and Freddie Mac purchase conventional loans. Okay, there are subtle differences between the two. It's the same type of loan terms that you would get. That does not differ, but each of them have subtle differences that come into play with underwriting. Overall, the basis of underwriting, they're very similar, but for example, Freddie Mac is much better with self-employed people. I don't know why that's the case, but they've been doing that 1-year tax return option forever. Like assets, okay? So people that Freddie tends to take those. Fannie seems a little bit more liberal with credit, and they also occurrences like short sales, foreclosures, things like that. So subtle differences, but both offering.
Ken. Ken. Ken, are you there?
Ken, hello.
I think that means I should leave. Since,
No, we
since
don't
my
want you to
internet
leave.
connection-
No.
Oh, you're back.
I think someone's trying to tell me something.
No,
Really quick before we lose your internet.
Yes.
Caesar, so Caesar asked again, so they're banks. So are they banks?
No. So what they are is they're called government-sponsored enterprises. So what they do is they purchase all the mortgages and they securitize them, where it's almost like a bond, right? So they don't originate the loan and they don't service the loan. You'll never get a loan from them directly. You'll never pay them directly. So they simply get these portfolios of mortgages, and then they securitize them into a mortgage-backed security. And you, me, everybody, we can go and invest in them. It's just a low risk, low return investment that's a safe investment. So the key thing with them is to make sure they continue to have the liquidity to want to continue buying. And if there's delinquency rates that rise, they may, hold up on the new loans they want to bring in. But that's where the government has been there to help them out. They helped them out in 2008 and 9. They haven't got any government assistance. They've got some stimulus things in place if they need it. But as long as they're stable and strong, then new lending will continue. We don't expect that that's going to be a problem.
Okay, great. And I just want to make sure, I'm not sure if you answered Alicia's question about, do you think the requirements are going to be more challenging with the pandemic? Because we were losing you for a little bit.
The only requirement I see or that we've seen that's become more challenging is just the employment factor of being able to justify that you're not going to lose your job a week after closing. And so that becomes a gray area because it's going to differ from person to person, but it's the only real change we've seen in when it comes to qualifying for a mortgage. Other than that, most of the requirements, aside from some of that credit score stuff I talked about, are still in play, and mortgages are going strong.
Okay, great. I don't think we have any more questions. We just got one from Catherine. Has Ken heard anything about something called the Nurse Next Door for healthcare providers?
Yeah, so there are some different programs out there for people that, depending on their industry, I mean, we do we kind of have our own programs that we give back to people in certain professions like that. We call it our Heroes program. So there are some benefits that people can do in that situation. But one of the things that you'll find out there right now is some of the funding for some of these programs that you might hear about, or, down payment assistance stuff. It's kind of all in flux right now because of some of the changes happening in the market. I think if anything is suspended right now, it will open up as things continue to open up. But I'd be more than happy to set up a call and talk about what we do for our heroes out there that we try and get back to help them out.
Okay, perfect, Ken. So one more question before we move on to Chris, our next presenter. So this question is from J and T Hollis. Is it better to wait and increase credit score to get a better interest rate, or purchase now while the rates are low?
So I would say it just depends, because depending on the type of loan you have and where your credit score is at, you may get the same rate whether you're at the score you're at now or a higher one. So that's going to really vary depending on the loan type. And, with someone like Chris, he can probably help turn something around credit-wise in a timely manner where you're not waiting like a year or 2 years to make this happen. He can probably get it done much quicker to then put you back in the game. But if the loan type is not going to matter, then I would say push forward now. And I would just also add real quick, people ask all the time, when's the best time for me to get pre-approved depending on when I want to purchase? My answer is this: if you decide that you want to purchase a home, get pre-approved. I don't care if you're doing it in 6 months or 8 months or a year. The sooner you know, the sooner you can start preparing with Melissa and her team on the price points, the area, all of that. So if it's 6 months down the road, dive into the pre-approval process and just know, because if you have to work on anything, you now have time to do it.
Okay, wonderful. And then I see here, I'm sorry, just one more question. I think it was sent to the wrong place, but this is actually from Nicole. In this current market, how likely is your mortgage being sold off? How does that work?
So every mortgage gets sold to Fannie, Freddie, or Ginnie, okay? From there, what happens is they designate a servicer. We service some loans. Sometimes they will designate someone else to service it. That happens in what's called the secondary market, which takes place about 2 weeks after your closing. Right now, what you'll find in our industry is the servicing departments that are out there, the servicing people that are out there. It's much more regulated than it was prior to 2008, where you just saw your mortgage sometimes switch servicers all over the place. That's not happening as often now, and that's because they redid that whole side of the industry, and so things are more stable. It's highly doubtful that people will see their servicing switch that much moving forward. If you do, it might be one time, and that's going to be it. We just aren't seeing the same activity we saw prior to 2008.
Okay, so we have the questions coming in here. All right, so one more question, guys, before we move on to Chris. We have a question from Denise. Are there any programs for home buyers that have a property already but want to purchase a primary residence, make a new purchase?
And before you answer that, Ken, I just want to say, you might think of some other questions. We will have a quick Q&A towards the end as well. So, because you might have more questions once you hear Chris's.
Yes, and of course, we can always set up a time to, chat after. If it's just, if everyone's got questions, we can always set up an additional time. But just to talk about real quick what you mentioned about, purchasing a new home and with an existing home, there's ways to do this. You just need to have a plan. We do a lot of them. And we've got some great ways that you can either, if you want to keep an existing property and rent it, or if you want to sell simultaneously. Melissa and her team have done a number of those with us. So there's a way to execute it. And just depending on what your goal is, we'll structure the loan accordingly. Thank you,
Okay,
guys.
great.
You have any other questions that came in?
Nope, from what I see here, I think we're good.
Okay, so before we move on, I am going to do a little raffle with compliments of Ken from Priority Lending. We have first a $25 Starbucks card. And you have to be present to win. So I see that there's a few people that did not show up. So if I call your name and you're not here, you're not going to get it. So if I call your name and you're here, then just put in the chat that you're here. If we don't see someone say I'm here, then we're going to move on to the next lucky person. So the first person that gets the $25 gift card, oh, nope. Sorry, I got to be able to see the name. Oh my. I don't see the name, hold on. Okay, so the first person is Giovanni Ocasio.
Yay!
So we're going to make a note. Are you here, Giovanni?
Yes.
Okay, perfect.
He says, yay, I love Starbucks too.
Awesome, awesome. All right, so we also have, let's see, we also have a $25 Dunkin' Donuts gift card. Dunkin' Donuts. From Ken at Priority Lending, the great folks at Priority Lending. Okay, and I'm having a hard time seeing this name here. Okay, so the winner is, and I don't see the first name, but it's R. Thorpe. Are you here, R. Thorpe?
R. Thorpe. Let me see here. Oh, yep, he's there. He's here.
Okay, congratulations. You got a $25 Dunkin' Donuts gift card, courtesy of Priority Lending. So thank you so much for being here, guys. And we are going to now move on. No other questions came in, Maria, right? Regarding lending. So we will move on. So our next speaker is Chris Colston, president of Second Chance Credit. Always love hearing you, Chris, and all of your good advice regarding credit. He works with NFL players, and we call him the credit counselor to the stars. I think we were the ones that came up with that. But he has dedicated nearly 2 decades to educating people from all walks of life on how the credit system works, how to maximize their credit ratings, and how to leverage that credit to improve their financial situation for the betterment of their family and communities. So this doesn't just apply to buying a home. This applies to purchasing cars, saving thousands of dollars by making sure your credit is at the best that it can possibly be. So it's all yours. I introduce you to Chris Colston. You can take it over, Chris.
Thank you. How are you guys? This is Chris, Second Chance Credit. I am so happy to be here. Melissa, you know how many times we have done these presentations
Yes.
with a panel. And let me tell you, I believe that this is really the best one. The information that you just brought up, Melissa, is great. Ken did an amazing job again. I'm learning. These are things that I listen from Ken, and I could pass this along to my clients, and it's just a wealth of knowledge. So thank you, Melissa. Thank you, Ken. I know Mark is going to close it up. You know, Mark is a great presenter as well. So thank you very much for that. This is amazing.
Yes.
So ladies and gentlemen, I'm going to share my screen now so we can go over everything about credit. So let me give you a little bit of background of myself. I always like to start with a story. I'm from Nicaragua. I came over here in 1989 with my parents. Both my parents, blue-collar workers. Mom and dad worked 2 jobs. Dad went into work at 3 o'clock in the morning, didn't come home till 7 o'clock at night. My mom went to work a little bit later, but also had 2 jobs. So it was very difficult for us growing up. You know, financially it was tough. And credit-wise, it was even tougher because there's no education about credit or finances in America. And there's one, the way I like to call it, a disgusting reason why there's no education on credit or finances in the United States. And that's because the United States runs on credit, runs on debt. So if the United States of America runs on credit, why would they educate you? Remember, ladies and gentlemen, the more money we are in debt, the more interest rate we pay. Right now, the average interest rate right now on a credit card is 17%. 17. The highest is 29%. So if you don't pay off your credit card bills at the end of the month, every month, you're paying anywhere between 17 to 29% more. You're giving this money away. This is why there's no education. This is why nobody teaches you. And remember, the more in debt you are, the harder it becomes to be able to get a loan, right? Because now you're full of debt. So if you get something out of this presentation I'm going to do today, is this. Remember, debt is the killer of dreams. Debt will kill all your dreams you had. You know, you want to purchase a home with Melissa, you want Ken to do the mortgage. If you're too much into debt, Ken will not be able to give you the loan. If you have too much debt, you cannot go and purchase a new automobile. You cannot purchase a car that you need. If you have too much debt, you cannot maneuver around. If you have too much debt with this pandemic, you're really struggling because right now, if you don't have any income coming in, how can you pay off that credit card? How can you send the minimum payment? So please, please, please do not get into debt. Today, I'm going to show you how to use credit, how to use your money, but not be in debt, and always maximize your credit score to the highest as possible. So this is a credit score range. Credit score, the lowest credit score that you can have is 300. The highest credit score that you can have is 850. That is the highest. Right now, the average credit score in America before the pandemic hit, right? So right now they have not calculated because a lot of people are missing payments. But the highest credit score, the middle credit score, the average credit score in America, I'm sorry, is 704 before the pandemic. So that says that if you do not have a 704 or above credit score, you are overpaying for things. The banks will give you a loan, but you're not going to get the best loan. You're not going to get the best rate. You're not going to get the favorable outcome out of that loan. I'm a firm believer that if you're going to do something, set up yourself so you could end up with the best of the best at that time. I know that it's very difficult for all the stars to align. I know that. I know that. But try to see how many of your stars you can align. And how you're going to do that by starting up, like what Ken said, start getting a pre-approval. Understand where you're at with your credit. Understand where you are with your finances. Because depending on how much money you make, Ken could tell you, Chris, you could qualify for 300. Chris, you could qualify for 400,000, and you're going to need this down payment. So then you know if you have enough down payment now or if you need to save up more, right? You have a game plan. Ken could also tell you how is your credit score right now. He could say, Chris, you could qualify for this, or Chris, you know what? If you increase it a bit more, this is how much better your interest rate will be, and this is how much lower your monthly payment to that purchase of the home is going to be. You always want to save money. Do not give money away for free, guys. We work too hard to give money away. Our families depend on us to give money away. So my target goal for everyone here is to be a 740 or above. If you're a 740 or above, you're always going to be well. You're always going to be that client that banks want. You're always going to be that client that a credit card company wants. You're always going to be that client that an automobile company wants. You want to be desired. You want to be that client that they want to give you the best rate. But don't take it like that also, because if you have bad credit, right, a lot of credit card companies want you too. They want you as well. You know why? Because they could charge you more. This is where they make more money. Don't get caught up in that game of paying more for things, because you're only making the other people rich and you're depleting your own assets, your own income. How to maximize your personal credit. Here's some great tips. Many people ask me, Chris, how do you build credit? How do you use your day-to-day to build credit? So one of the easiest ways to build credit is to purchase a home, to purchase an automobile, right? That's the major two things that boost up your credit high. But before you can get there, you need to structure the foundation. How are you going to structure the foundation? What I like to call is your normal daily expenses. The expenses, the daily purchases that you do day in and day out. Like right now, we're actually structuring our new office, right? I have a couple of people here. I went to go buy them breakfast, some pastelitos. It cost me $50. I could have purchased that with my debit card. I could have purchased that cash. But what did I do? I put it on my credit card, right? At the end of the month, that bill will get paid off. So now I use my own money to make me credit, to help me get credit. If I go to Publix to buy groceries, instead of buying it with a debit card or instead of buying it cash, that does not give me any credit. I'll put it in my credit card and I pay it off. Now, here's a key term that I've been saying, and it's there in the presentation. You have to pay it off. If you do not pay it off, then you're going to be paying interest on it. You got to be able to keep track of your expenses. One of the great apps that I love to use, I did not put it here in the presentation, but I'm gonna tell it to everyone here, is Mint, M-I-N-T, mint.com. Get that application, because in that application, you can input there spending limits that you can put on yourself. So you say, okay, I do not want to go over $200 in this credit card. Set an alert if I go over $200. Or I don't want to go over $500 or $1,000. Always set something up that you know you're going to have at the end of the month to pay it off. Because if you don't set those alerts, then you could overspend. Remember, in your credit card statement, when you see your statement on your credit card, what does it say? It says how much money you owe, and it gives you a minimum payment. Of course, it gives you a minimum payment. The minimum payment is this little. It's very minimum, because they want you to pay the minimum payment so they could charge you interest. Don't get caught up on that. So your daily expenses, groceries, gasolines, breakfast, lunch, dinner, use your credit card if you can and pay it off. I actually pay my credit cards every week, because ladies, gentlemen, I do not want to sound like a hypocrite. As anyone could get into trouble, I can also get into trouble. Melissa could get into trouble. Ken could get into trouble. Stephanie could get into trouble. Everybody could get into trouble if you do not set boundaries on your money. All right. So I actually pay my credit cards off every week, and I only use 3 credit cards. So I don't lose track on what I'm using and what I am spending. If I'm spending too much, I'm like, whoa. You know what? Let me pump the brakes. Actually, this pandemic has actually helped me out a lot, because it's shown me how much money I spend. Now I'm actually, wow, I could actually save more money than I was spending before. So this pandemic's actually structured me personally on how to be a little bit skinnier on that. So now I can save more money and not just go money away on things that did not make sense at that time. Okay? So always remember that. Debit card and cash do not give you any credit. Do not. The only things that gives you credit is a credit card, an automobile, or a home loan. So look how tricky it is. They want you to have good credit by using a credit card to get into debt, but they don't show you how to manage that credit card and how to manage that debt. It's literally a slippery slope. This whole system of the credit system is perfectly designed for us to fail. But I'm giving you the tricks today on how you can leverage that, on how you can make this thing work for you. Do not let the status quo be the status quo. We're going to break that status quo, and we're going to use this system to benefit us now, tomorrow, and the future. We're going to move on now to fast track to higher credit. If you have bad credit, or you know someone that has bad credit, many of my clients ask me, Chris, what is the easiest way to get started again, to get first gear on? A secured credit card. A secured credit card is a prepaid credit card. Usually it's a credit card that you deposit money into. Let's say one of the banks that do secured credit card is Citibank, TD Bank. A couple of credit unions do it. So instead of you using your debit card, that's your own money, it doesn't give you any credit. When you get a secure credit card, you deposit $500, $1,000, whatever you want to deposit. You can actually go up to $10,000 on the secure credit cards. Whatever you deposit becomes the limit that you can use towards purchases. So if I get a secure credit card of $1,000, so I deposit $1,000 there, I can use $1,000 in the month, and it will give me credit. So just like a debit card, whatever money you have in the debit card, you can use. Whatever money you deposit in the secured credit card, you can use as well. At the end of the month, they'll send you a bill, and you got to replenish the money back again. So it's a credit card that starts teaching you how to manage the credit cards the right way. So whatever you purchase, you got to replenish. Whatever you purchase, you got to replenish. But it's showcased on the credit bureaus as a regular credit card. So this is a great way to start up the credit. So for people that have bad credit, new credit, or credit after a bankruptcy, this is a great way to be able to start the credit up again, and it'll start giving you points immediately. Now, this right here is my favorite thing. If you heard my presentations before, you've been a client of mine, this is something that I push, and I love it. It's called authorized user. So for an authorized user here, it means that you're going to piggyback someone else's credit. So let's say Melissa Miller has a credit card that's 20 years old, right? And I'm Miller's cousin. I say, Melissa, my credit is poor. Chris, the credit advisor, asked me if you could add me to that credit card. Melissa says, okay, Chris, I'll add you. She calls her American Express, and she says, American Express, I want to add my cousin Chris to my American Express. Once they do that and the American Express accepts me, what I'm doing now is that I am getting all the 20 years of credit that Melissa has developed. All that 20 year. All the 20 year also of credit limit. Let's say Melissa Miller has a credit card that's $20,000. Now I inherit that as well. So I'm inheriting the 20 years of relationship that Melissa has generated with American Express, but I'm also generating the $20,000 credit limit that she has. So automatically my credit becomes stronger. Many of my clients ask me, Chris, does this hurt Melissa? Because you have bad credit. When Melissa adds you to her credit, does it hurt her? It does not impact anything towards Melissa. Because Melissa, when she adds me onto her credit card, they're going to ask her, do you want Chris to get a credit card? And she's going to say, nope, I don't want Chris to have a credit card or any access to my account. I just want him to be part of it as an authorized user. So this is a great boost. If you could get 2 or 3 authorized users, this is something that will increase your credit score also in just 30 days. So now let's say Ken is looking at your credit and it says, you need about 10 to 20 points more to qualify. If Ken says, you know what, by you being added to this authorized user credit card is not going to impact our qualification or underwriting, then you should do it, because it'll probably give you that 10, 20 points more right away within 30 days. Now, here's the caveat, okay? Here's where you got to be very careful with this, though. And I'm using Melissa here as an example. Let's say Melissa used up that credit card. She went on vacation, with her family. She used up that credit card and she put a lot of debt into it. Guess what happens now? I now have that debt in my credit, because now it's a mirror image. Whatever Melissa does with that credit card, it reflects on me as well. So if Melissa adds debt, I have debt now. If Melissa by any chance misses a payment in my credit, I miss a payment as well. So I cannot hurt Melissa, but Melissa could hurt me. So you got to be very careful on who you become an authorized user to. You do not want to become an authorized user to someone that's very irresponsible, someone that has bad spending habits, or someone that you think is going to miss a payment because their track record's not that well. They're not that responsible. But if you have someone that's responsible, that does well with their credit, does well with their finances, and they're willing to help you out, and add you as an authorized user, it's a game-winning shot. Literally, it's probably one of the most unfair advantages that are out there. All right? And here's the great thing about that. You can remove yourself as an authorized user at any time. So you could be put in and you could be taken off. So an authorized user is not a joint account. A joint account is when Melissa and I apply for a credit card together, we sign it off, and her and I are together. So we're like married. That's a joint account. An authorized user is like we're dating. We could date and then we could break up. We could date, we could break up. But when you do joint, you're married. The only way I could get out of that credit card, that joint credit card with Melissa, is that if that credit card goes to zero balance and we close it. It's like a divorce. That's the only way. But an authorized user, you could come in and you could come out. So it's really, really good. I'm always a believer to ask if you have a mother, grandfather, grandmother, someone with old credit, 10 years or above, it gives you a great boost on your credit. I love them. Credit line increases. This is always something good as well to do. A lot of people always are searching for a better credit card, a better credit card, a better credit card. I want a credit card that has a bigger credit line. And then you start applying, you start applying, you start applying. You don't have to do that, ladies and gentlemen. You literally, if you have next to you a great friend, a great associate that you've been with a long time, like a good credit card, right? You could just call them and say, hey, I've been so good with you. You've been good to me. I want a little bit higher credit line. Can you increase it for me? If they increase it, they're going to ask you, how much more increase do you want? I'm a firm believer that you want to ask for 100% increase. So if you have a $5,000 credit card, you want to increase it to $10,000. You guys will be like, Chris, but why do I want to have a $10,000 credit card? What's the benefit of it? The benefit of it is that it's going to showcase that you're stronger with your finances, that you're stronger with knowledge of credit. Remember, you having a $10,000 credit card does not mean that you have to use $10,000. Doesn't mean that you have to use the whole $10,000. Doesn't mean that you have to use $5,000. You can use $100 a month on it. You can use $500 a month on it. Actually, I want you to use very little of that $10,000. Because remember, the less money that you use per month, the less debt that you have. The less debt that you have, the skinnier you are with debt, right? And the higher the credit score will be. I just want you to look very financially strong. So the stronger the credit card, the bigger the credit card, and the lower the debt, the more financially savvy you are. The better you will look for a bank and for a lender. They want to do business with people that are good with money, are good with credit, without any education on money or credit, because there's no education on this. So I'm giving you those tips on how to be able to manipulate the system and you be able to come up top of it. Now, this right here is something that Ken loves. debt reduction. You do not want to have that. The lower the debt you have, and we're speaking right now about mortgages, okay? The lower debt you have, the easier it will be for Ken to approve you. The easier it will be for you to qualify for your dream house. The easier it will be for you to make that payment for your dream house. The more debt you have, the more cautious Ken has to be, because he doesn't know if you're going to have a job tomorrow. He doesn't know that this debt, this new mortgage is going to tip everything off and everything's going to start overflowing. He doesn't know that. So if he doesn't know that, he has to be able to go like this and be really like, I don't know about you. But if you have no debt, you're going to really just go in a fast track. So what do I mean by debt reduction? If you can pay off your credit cards every month, that's what I want you to do. I'm a credit specialist. I'm a credit advisor. That doesn't mean that I'm a person that tells you get into debt. No, I don't want you to be in debt. Remember, debt is the killer of dreams. But if you do have debt, if you do carry some debt, you're like, Chris, I cannot pay everything off. I know Ken wants me to pay everything down. I cannot pay everything off. If you only have 25% of debt per credit card, your credit score will still be strong and you will still be a good candidate. All right? So for example, if you have a credit card that gives you a $1,000 credit limit, you could only owe $250. That's it. If your credit card is $10,000, you could only owe $2,500. I actually I like to spin it in a little different direction. I don't like to say that you owe. So if you have a $1,000 credit card, the way I would like to tell you is you could only spend $250. You could only spend 25%. Because if you spend 25%, I want you to have in your mind, we're going to pay off that 25% at the end of the month. Whatever you spend, pay off. Whatever you spend, pay off. This will help you increase your credit score by a lot. Now, in the bottom, you see the last one says pay off credit cards monthly. That right there is your number one tip. So out of all these things to fast track to higher credit, if you pay off your credit cards every month, your credit score will always be well, always. Here's the Mint right here. I love this. It showcases you here how Mint works. So it's an all-in-one solution. So now Mint is gonna help you see all your finances. Okay? It's gonna tell you how much money you have coming in per month. It's gonna tell you how much money you have going out per month. So if you're making $5,000 a month, and you're like, Chris, I make $5,000 a month, but I don't know where the money is going, this is gonna help you solidify where the money is going. It's gonna tell you there, you're gonna be able to input in the Mint credit cards, automobile loans, mortgage, student loans, investment. It's going to show you your whole money chart, how your money operates per month. And at the end of the month, it's going to give you a pie chart. It's going to tell you exactly where your money is going. If it's going to gasoline, if it's going to restaurants, if it's going to clothing for your kids, if it's going on vacation, you're going to see how you manage your money every month. So if you know where the money is going, and if you recognize a leak, you can fix that leak. Listen to what I said. You can fix the leak. I don't want you to put a Band-Aid over it, because what happens when you put a Band-Aid? It's going to come off. But if you know exactly where the problem is, you can fix it, and you can fix it forever. Also, Mint will help you set up payment reminders. So let's say your payment is due every 10th of every month for a credit card. You could set Mint to remind you on the 10th about that payment, or you could say, Mint, I want you to remind me 5 days before, 10 days before, so I don't miss the payment. You can make payments from Mint to your credit cards, to your automobile. You could be on vacation. You could be in Alaska, and the Mint app will come in and says, hey, Chris, your bill's due today. You say, pay, boom, it gets paid. You don't even have to think about it. So I'm trying to give you all these tips, but I'm giving you all these tips, right? But I'm also putting a protection. I'm putting a fence line. I don't want you to get crumbled. I don't want you to get tackled by the tips I'm giving you on the authorized user, on the secure credit cards, on increasing credit limit, if I don't put a barrier to protect. Because if I don't put a barrier to protect you, something will come in and hit you. Okay, so this right here is awesome and it's free. The mother company of Mint is Intuit, QuickBooks. So whoever used QuickBooks, have used QuickBooks, this is QuickBooks for personal. It's awesome, awesome, awesome. It gives you credit alert. Actually, Mint right now, Intuit just bought Credit Karma, just so you know. So now they're going to be able to showcase 2 credit scores for you. It's also going to help you budget. So let's say Ken tells you you're going to need 7.5%, right, for the purchase of the home. And you're like, okay, how am I going to be able to generate that? How am I going to be able to save? So you could tell Mint, I need $10,000 by the end of the year. So Mint will start budgeting you and says, okay, you need to cut here, you need to cut there, you need to cut here, so you can get to that $10,000 that you need to save. And if you shift during the month on that, Mint is going to tell you, Chris, you're not on par to meet your goals for the month, so you can save that money, so you can keep on track for the money that you want to save. So Mint is so good, it's going to be annoying. But if we want to achieve the goals that we want to achieve, we need to do something different that we've done before. And guys, this pandemic has been teaching many that I've spoken to, has been teaching me on how much money we spend on BS. Literally, PS. Much money we spend. All right? We need to secure money. We need to keep our money tight. Because in these times like right now, the people that have money, the people that have credit are the people that are going to be able to take advantage of opportunities that are out there. And there's a lot of opportunities that are going to come up. Like Melissa was saying, in the housing market, a lot of opportunities. You want to be that person when the floodgates open up again, and they will open up, you want to be the first boat out. You want to have all your ducks in order. And one of your ducks in order is your finances and your credit. Let's move on to the next one. Ladies and gentlemen, this right here is the formula that everyone wanted to keep a secret. The banks wanted to keep a secret. The credit bureaus wanted to keep it a secret. Because if they keep it a secret, how can you maximize your credit score? So let's go back to that. Why do they want to keep this a secret if our finances, our ratings get rated by our credits? So they're telling you, we're going to play a game, right? The credit game. This is how you're measured, but I'm not going to give you the rules to the game. It's going to be the Wild Wild West. How long do you think it's going to take us to figure it out? A very long time. So when they had to release this, then everybody's credit started getting better, because now you're like, okay, if this is this, I could plug this in, I could plug this in, I could plug that in. So I'm going to tell you now how to use this, okay? 15% of your credit is your length of credit history, how old your credit is. But look how tricky that word is, how old your credit is. You could say, you know what, I've had credit for 30 years, I should have good credit. But what about if that 30-year-old credit that you had was your first credit card that you got when you got out of high school, right? When you entered college. And then you say, you know what, Chris, I never use it. I don't use it. When you close that credit card, you closed up the whole relationship that you had. So now the length of credit history is gone because it's not open. It's an old friend that you do not even talk to anymore. It's not giving you credit history of active accounts and day out. So ladies and gentlemen, if you are not using a credit card, they will close you. The credit card companies will close you, because why would they want to have money out there on you that you're not using? If you have a $5,000 credit limit and you don't use that credit card, the credit card company is not making money on you. So I'd rather close you and give it to somebody who's going to get into debt, and now I make money out of it. So you need to use the credit that you have. You need to use it very little, but pay it off. You do not want to close off accounts. Now, there's some ladies and there's some gentlemen that have way too many credit cards. That's also that Ken will not like that. If Ken starts seeing that you have 10 credit cards, 15 credit cards, he will not like that at all, because now you're too dangerous. You're too dangerous because you have way too many strings that you can touch. You have way too many ways that you could get into debt. He doesn't like that. No banks likes that, all right? So you only want to have anywhere between 3 to 5 credit cards. That's it. If you follow that guideline, 3 to 5 credit cards max, and only use 25% maximum and pay them off at the end of the month, you will always have great credit. Even in a pandemic, you will have great credit because you will not be too much into debt. Anyone could probably get out of debt if you owe 25%. But if you're owing 50%, 75%, 100%, how are you going to get out of that debt? You won't. This game is strictly made for us to fail. We need to know how to play the game. So length of credit history. New lines of credit. So new lines of credit are new credit cards, new loans, new things that you buy that you put into your credit. So they're giving you points for getting into debt, in other words. So if you have a stable credit, you do not want to get into new lines of credit because you don't need it. But now if someone has bad credit or no credit, you need to open up some accounts so you can start boosting you and give you the new blood of credit, okay? Now, types of available credit. This is extremely important. Types of available credit are what type of credit cards you have, what type of loans do you have. You do not want to have just 2 credit cards from one bank. So you do not want to have Bank of America credit card, Bank of America credit card, Wells Fargo credit card, Wells Fargo credit card. No, you want to have a Bank of America, an American Express, and a Discover. So you want to have variety. Because if you have Bank of America, you only have one friend that's saying good things about you. It's a little bias. It's like me asking my mom what she thinks about me. I could have done something bad yesterday. And my mom would be like, no, Chris is perfect. You know what I mean? She's biased. So if you have multiple friends that they're different and they say good things about you, that makes you more credible. So you want to have that, okay? You want to be diversified. 35% is your payment history. This is how you make payments back. This is how trustworthy you are. If I lend you money, are you going to pay me back on time? If I lend you money, are you going to pay me back? Remember, ladies and gentlemen, paying back a debt is paying it back within 30 days or less. If you pay it late, if you go over 30 days past due, then that's considered a late payment. If you're a late payment, that showcases that you're not trustworthy. You're not organized. You're not financially wise. You're not financially wise. You're not credit wise. They don't want to do business with people that are going to miss payments. They don't. And if they do business with you, they're going to charge a higher interest rate because they're going to protect themselves because you have developed a pattern of bad payments. You have developed a pattern of a client that's not responsible. So if you're not responsible with a $1,000 credit card, a $5,000 credit card, right, that you miss some payments, what makes you think that you're going to be responsible with a $200,000 home loan, a $300,000 home loan? No, it's not going to happen. And if it does happen, you will be paying a higher interest rate. So you'll be giving money away. So this is where a professional like myself comes in, that I help you fix these items. But I'm giving you the tips now so you do not get to that point, all right, of missing payments and your credit scores dipping. Now, debt to available credit. Going back again to debt. 30% of your credit score is based upon debt. You could have a perfect credit. I've seen clients of mine, perfect credit, no late payments, no charge-offs, no collections, no bankruptcy, no repossession. Perfect blemish-free credit. And the credit scores are still 620. Why? Too much debt. Everything's maxed out. Again, debt is the killer of dreams. If you have too much debt, how can you be responsible for another debt? That's like giving drugs to a drug addict. You can't do that. You can't do that. The lenders will not do that. Get out of debt. And by getting out of debt, it's not getting into debt. Now, look how cool this is. This is the whole credit score formula, right? Out of everything that we were talking about prior, about the fast lane to credit, how to boost up your credit quicker, there's one of those products, one of those things that I mentioned that summarizes this whole pie chart. And that's the authorized user. Going back again to the example of Melissa Miller. If Melissa adds me to her American Express, that's 20 years old, I gain the 15% of lent to credit history. I automatically get that from Melissa. So I gain 15%, right, in my chart. Now, I also gain the new lines of credit because now I get a new credit card in my name, right? A new credit card in my credit. So I get 10% also. I also get 10% of available credit, a different type of credit card. I also get 35% of payment history because I know Melissa Miller pays her credit cards well. I know she's responsible, so now I gain 35% as well. And I know Melissa does not carry a lot of debt, so now I gain 30%. So by me being added to Melissa's credit, I satisfy this whole pie chart. This is why it's so important. If your credit's not strong enough or you need a bump, right, those extra points to be added to someone's credit card as an authorized user, but a responsible person. You want to ask them, this is one of the tips that I give my clients. You want to ask that person what type of credit cards they have, right? How old is their credit card? 5 years or above. If you have somebody that's 5 years or above of credit with them, that's what you want. You want to see how high the credit limit. The higher the credit limit, the better. And now you want to see the debt. So if they have very low debt, that's what you want as well. Okay, so types of credit card, length of credit history, credit limit, and how much they owe. You want to ask those questions. This right here is an extremely important slide, your credit mistakes. Maxing out your credit cards. If your credit score is 580 to 680 to 679, you are losing 10 to 30 points just by having that maxed out. And remember, maxed out is not being at 100% in debt. Maxed out is just going over that 25% threshold. That's what people don't understand. They trick you. You think maxed out is 50%, 75%, 100%. No, going over that 25% threshold. But look at this. If you have a higher credit score, look how much you get hit. You're losing 45 points. So, and this is not an overall credit. So let's say if you have let's say you got 3 credit cards. All of them are at $5,000 credit limit. So you think in your mind you have $15,000 and you're saying, you know what? I only owe $5,000, but I owe $5,000 in one of them. So your credit score will not be high as possible because on one of those credit cards, you're fully maxed out. So it's not an overall pie chart. It's an individual pie chart. Every single credit card, you cannot be over 25%. If not, you'll lose points. A late payment, if you see here, a late payment or a collection account gets reported into your credit, you're losing from 1 month to the other 60 to 110 points. Ladies and gentlemen, 60 to 110 points by missing that one payment. By you not downloading mint.com, by you not being on top of your credit and your finances, by you not seeing your bills. That blemish, if you don't get it fixed, will be on your credit for 7 years, even if you paid it off. So it's a scar that you have. So you're still walking, you could still go to the bank, you could still ask for loans, but the bank is gonna be like, Chris, you have a scar here, you have a scar here, you have a scar here. What happened? oh, I missed some payments. I had some stuff back in the day. They're like, okay, Chris, I see that you're back, you're doing well again. You're back again, but you had these things in the past. And you know what? I got to charge you more. So if you don't get those items fixed, you'll be paying for that repercussion, for that action for 7 years. So you do not want to be 30 days late, and you do not want a collection account to hit there. The most common collection accounts that I'm seeing now is medical collections. If you get a bill, if you go to the doctor for yourself, your husband, your kids, and you get a bill, don't just assume that the insurance company is going to pay that. If you're getting a bill, that means that the doctor or the hospital and your insurance company are not talking very well. There's an outstanding balance, and you may be responsible for that debt. And if you ignore it, now it's going to go into your credit. Imagine if you are due for closing. You're in the closing table, and Ken has to run your credit again, and now there's a new collection account that popped in, and you lost 60, 100 points. And now Ken says, Chris, I cannot do the loan anymore. What do you think is going to happen? You probably may lose your deposit on the house because of loose strings that you have. So please, please, please check your credit. Please do not throw away mail that comes into your house. If you move or you use your parents' home address, somebody else's home address, please go and get that mail. There's so many things that come in there. Okay. Also utilities, satellite dish. I see that a lot on credit report. Oh my God, I never returned back the satellite dish or the cable box. Yeah, these companies are going to charge you for that. And if you don't monitor your credit, then you don't know what's in your credit or what's coming in your credit or what's happening to your credit. You need to be on top of your credit. This is the game that we're playing. So if you don't educate on this game, how are you going to be the best of the best at this game? You cannot. This is why Melissa is putting up these seminars. So you could talk to her trusted advisors and professionals so that when you do decide to purchase a home from Melissa, you have everything as good as possible. So you get into the most favorable home at the most favorable loan with the least amount of down payment. So you have a house forever. Okay? Debt settlements. Guys, I'm going to give you a great tip now with the pandemic, okay? And I don't want you to get tricked with any other type of debt settlement. There's some debt settlement companies, third-party companies that will tell you, look, we will help you settle your debt. When they do that, or if you have done that, or you know someone that's done that, the first thing that company tells you is stop making payments on those credit cards. Stop making payments on them. The reason why they're telling you that is because they want your credit scores to drop. And by you stopping that payment, right, they want to get the awareness to the credit card company and say, hey, look, my customer is in distress right now. He cannot make payments. You need to discount the loan, what they owe. But remember, these companies charge you 20% of your debt. This is why they won't take you if you don't owe $10,000 or more. Because their minimum fee is $2,000. Because now what they're going to do is that they're going to help you negotiate that debt that you have by 50%. So you're going to end up paying 50% back to that to the loan, that credit card loan that you had, right? You're going to end up paying 50%. Plus, you're going to pay them a 20% fee. So what are you saving? 30%? And your credit score's all messed up because you have all these late payments from the past? You didn't do anything. Now, I'm going to give you this tip. If you have debt, if it's very hard for you to get out of debt, every credit card company has this program. Now, more people are using this program, but every credit card company has this program. It's called the Hardship Department. The Hardship Department. So you call them and you tell them, look, I'm struggling with money. I'm struggling with finances. Can you help me with this interest rate? 9 out of 10 times, what they'll do is that they'll cut the interest rate. I've seen companies do 0% interest rate up to 60 months. I've seen that. I've seen some just do it for 6 months. I've seen some do it for 12, 24 months. But one company I saw for do it for 5 years, 60 months at 0%. Because the customer was a good customer always with them. They never had a late payment. They always were good. But you know what? They got into financial problems. But here's the cool thing that happened to it. They'll freeze your account. So they're not going to give you a 0% interest rate and you still could use it again. No, they'll freeze your account. So now all that money that you're sending will go to principal. You cannot get no more into debt, right? Once you pay that off, then they'll reopen that account. Now with the pandemic, with the COVID-19, a lot of these companies are doing that as well. They're giving customers a break. They're reducing the interest rate. Because remember, these credit card companies, these banks, they cannot just operate with customers that they're defaulting, because now their portfolio gets diminished, their value of the portfolio gets diminished. So they have to maintain a certain level of portfolio of a good grade of portfolio. So they're willing to help out their clients so they don't have so many clients at default. So this is a great opportunity for yourself to be able to get out of debt and not hurt your credit like the other debt settlement companies will do. This is why the debt settlement drops your credit score so much, because you have to miss payments. And in the debt settlement, if you get into a debt settlement and your credit report says debt settlement, in debt settlement program, that means that you paid a third-party company to make payments for you. How responsible do you look at that time? Remember, this is your credit report is your credit report is your report card. Just think back when you went to school. You had A, B, C, and D.
Chris? Okay. I think he's the only one frozen. Let's see. Hello, anybody there? Chris?
We can help you fix that. If you had a short sale before, we can help you fix that. If you had a repossession before, we can fix that. If you had a bankruptcy, we can fix that as well. So here's how you can reach me, but I will leave you with one last tip. When you look at your credit report, one of the first things you want to look at when you order your credit report, the best website that I like is Experian.com. When you order the credit report and you review it, you want to check how your name is being input into the credit report. Like my name, for example, is Christopher Alexander Colston. If I have Chris Colston, that's not me. If it says Chris A. Colston, that's not me. Now, those are different AKAs of me. And if I have different AKAs, that means that somebody is capable to stealing my identity. Because now, Christopher A. can mean Christopher Anthony Colston, right? Christopher Alejandro Colston. It's not Christopher Alexander. So you need to look at the AKAs on your credit report. Also check there on your credit report the home addresses, the addresses reported there, right? Because now, let's say, for example, if in Melissa Miller's credit report is showcased as my address, that means that I stole her identity to buy something or to use her identity for something. I actually had a client 3 years ago in North Carolina that she was going through a divorce. We saw a new address on her credit report. When we looked, I was like, what is this? She went to that address and she saw her ex-husband's car at that address. Her ex-husband had her credit. So he probably got a utility. He probably did something with her credit. And boom, it went through. Remember something, your name, well, your name you could change, one time you can legally change it, but you cannot change your social security number. You cannot change your date of birth. So when someone steals that information, they will have it forever. If you guys recall the Equifax breach, that impacted so many Americans, those thieves, if you were part of that, those thieves still have your information. They still have it. They can strike at any time. So if you don't monitor your credit, how do you know you're a victim of it? For any questions, ladies and gentlemen, again, my name is Chris Colston. This is my website. You have there my Facebook, my Instagram, and my Twitter. I could give you my phone number. Melissa has it. And I will send Melissa this presentation here that I just showed you guys. I'll send it to Melissa so she could forward it to everyone there that's participating today. And you can have all this knowledge there at hand.
Thank you so much, Chris. You're always so generous with the information, and we appreciate it. This is real good tools that we can use to make sure we optimize our credit and that we have the best credit health, really, so that we can take advantage of as much as possible. So thank you again, Chris, as always. And Chris, Maria, I should say, Maria, we have any questions?
Yes, we do. We have a couple of questions for Chris. The first question is from Gert Nord, and I'm sorry, I'm not sure if I'm pronouncing your last name correctly. If I remove myself as an authorized user, would that affect my score?
Yes, it will, because now you're that line of credit, right? That positive trade line that you had, now you're sucking it out. So you do not want to remove yourself as an authorized user unless you have set up something else to replace it. So if we're speaking right now about purchasing a home, you do not want to remove yourself until you purchase that home, right? And now you probably get another line of credit, another credit card to be able to supplement that authorized user.
But if it's a negative, if it's somebody and they're trying to save themselves from a negative impact, they just have to find maybe another authorized user that's positive to make sure that it evens out.
Correct.
So,
Yes.
Okay.
Yeah. So let's say in that example that I was using with you, Melissa, let's say Melissa went to some financial, some financial difficulties, so she missed a payment, right? And now it's impact me. I need to remove myself from Melissa's credit because now that credit card's affecting me. So yes, I could remove myself at any time. Sometimes it's a good reason, sometimes it's a bad reason, but you can remove yourself. Yes.
Okay, perfect. Thank you, Chris. So the next question is from Tabria W. Her question is, so paying off my debt first is highly requested before purchasing a home?
Yes, please. Ken will love that. If you have no debt or you have minimum debt, your credit score will only increase, and then that could, and then Ken could qualify
Okay, you froze up a little bit there.
For a better home.
Okay. Stephanie, are you hearing me? Okay, it looks like I'm the one. You guys can hear me?
You're making now, they'll be like, okay, they'll jot it down, they'll be like, okay, we'll just give you that credit line. But I'll tell you, look, I need to check your credit, right? That can impact your points because that's going to drop you 5 points. And that can also go a little curveball to Ken because now it's showing that someone's trying to get another loan. So these are steps, these are tricks that I want to give to you that need to be done way before. Okay, this is something you want to do 3 months before, 6 months before, so you can start preparing yourself to get that credit score as high as possible. Because once Ken runs the credit, that credit report and correct me if I'm wrong, it's only valid for 90 days. So within that 90-day trial, the 90-day window that you're with Ken, you do not want to add any type of debt, any type of additional credit or credit inquiries, because it will hurt Ken.
Well, we'll add to that because I don't think Ken is on the call anymore. But it's depending on what you think your credit is, definitely call Ken and let him know. If you think your score is kind of borderline, at least he would be able to guide you on what needs to be done. I know that with our clients, even if they're 6 months down the road, he likes to have a consultation with them. And at least, because some people have no idea what's on their credit. So at least if you pull a free credit report, or Ken, takes a look at your credit, he can give you a plan going forward for the next 6 months on how to basically maximize your interest rate. Because depending on what type of program you're doing as well, because some programs, the credit score doesn't matter as much as some other programs. So he can kind of guide you overall on what's the best path.
And also here, because we're part of Melissa Miller's trusted advisors, Ken and I always communicate with the clients that we're working together. So Ken will send me the credit report. I will talk to him. I'll talk to the client. We'll design a game plan, and then I will know how much wiggle room. I know how much time I have. I know what I can set up, what type of game plan I can set up, and how aggressive we can go or how conservative we need to go. Right. Everything is just planning.
Because all of our clients don't have all of their, although it's ideal, they don't have all of their debts paid off when they buy a house. But we want to be able to consult with you and give you the best path, whether it's realistic or not to have all of your debts paid off compared to your needs, what your needs are right now as far as owning a home or having a place to live. Maria, I think something else came through.
Yes, and by the way, just a side note, our consultations are free, so feel free to give us a call. We can meet with you at any time on the weekends by appointment. We make ourselves available for you.
Yes.
Okay, so the next question from Caesar Johnson. I use one, I'm assuming he's comparing it to the Mint program that you're mentioning, Chris. So he's saying, I use one called True Bill. You can pay whatever you want for it to get full access. They also help you shop for better rates on things like insurance. It saved $75 a month on my car insurance with the same coverage.
Right. I love it. Anything that can help you out, anything that lets you see more than you can see is great. I love that. Get educated. And I love that people are trying to get educated and searching for help. That right there is a great testament. You're on the right path, Caesar.
Yes. So the next question is from Alessandra Abrahams. Will it affect my credit score if I remove an authorized, we already went through this, but yeah. I guess you can briefly, will it affect my credit score if I remove an authorized user from my account?
It will not hurt your credit score, no.
Okay.
If Melissa removes me, it will not hurt her credit score.
Okay, good example. The next question from R. Thorpe. If I cancel my credit cards, will that negatively impact my credit? If so, for how long?
It all depends. If it's a credit card that you just opened up 5 months ago, it's not going to impact you that much. But if a credit card that's 20 years old or 10 years old that you cancel, it will impact you, right? And for how long, it all depends how you're able to reestablish credit afterwards. What type of credit card are you going to get next? How are you going to supplement it? So it will impact you. But for how long, I don't know, because for that, I will have to see a credit report and be able to design a game plan specifically for you and for what you're trying to achieve. Remember, every client has different needs. Every client is in a different situation. So we need to sit down or we need to talk so I can design something that's going to be beneficial for you and for your goals.
Okay, and this question is from Anonymous. Similar, I guess the same topic. If your credit account is closed, does it damage your credit score? And is it bad if you don't use the card anymore?
Yes. If you don't use a card, then they're going to close you. So yes, it will affect you. And if it's something's already closed, it's closed. So it's not giving you any positive credit. It gave you credit, still in your credit history, something in the past, but it's not giving you credit right now on the day-to-day basis.
Okay, great. Thank you so much. So thank you everybody for the questions. There were some good questions, and I believe that is it for Chris.
Thank you, guys.
Oh, James said, Chris, your information is always current. Great job.
Thank you. Appreciate
Thank
that.
you, James.
Appreciate that.
Yes. So I'm very thankful, Chris, for all of your information. We could talk all day about credit and how's the best way to structure it and get your credit score up and be able to benefit from saving thousands of dollars. So it's always good information. So Chris has a $25 Cheesecake Factory gift card. We can't wait until Cheesecake will
Yeah.
back up. So some lucky winner will have. And the lucky winner is, it says Jasmine Johnson. Are you here, Jasmine Johnson?
Jasmine, let's see if she's here.
Jaz
Oh, here we go. Jazz Johnson.
Johnson. Did she respond to say here, or are we moving on?
No answer yet. Remember, you guys have to let us know you're here so we can get you the gift card. If not, we'll move to somebody else.
Okay. All right.
Let me. Oh, here we go. Wait. Wait. This says from T. Is that? No, that's not Jazz. Looking for Jazz Johnson. Going once. Going twice.
You type in quick.
Listen, I'm about to take that gift card. Nope. I am not here. Sorry, not Jasmine. This is T. Yeah, no, I don't think Jazz is here, guys. Oh wait, there we go. Jazz, you made it. You were saved by the bell.
Take us out for lunch. Well, congratulations, Jazz. Somebody said, oh man. Well, don't give up hope. We still have one other gift card coming up after Mark Bookstein speaks. So let me just introduce Mark. He is the president and owner of Title Guarantee of South Florida. He's always the consummate host of his lovely office in Weston. That's usually where we have the seminar. Title Guarantee has been servicing real estate professionals since 1985. And he's going to tell us a little bit more. What is a title company? What do they actually do? How does it benefit you? So thank you, Mark, for being here. And we're going to turn it over to you.
Okay, so we are a Title Guarantee of South Florida. We're owner-operated, attorney-owned, operated title company in South Florida. We service the whole state of Florida. We are the final piece of the puzzle when it comes to real estate. After you get under contract on the property, we're the ones that prefer the escrow service, insure your property. We check your property for liens, judgments, title issues. We're the ones you give your deposit to. We're the ones you see at the closing table. We're the ones that make sure that your transaction is handled and insured properly and you have no issues moving forward with your property. We do all different services between deed preparation, closing services. We do it all. But our main objective is to make sure when you buy your home, you're protected and you have title insurance. Your lender is required title insurance to get the loan on the property. So we have to provide that for them also. So without us, we are an integral part of the puzzle as far as the title process.
Awesome.
Yeah.
Okay.
What I'm going to do today is I'm going to go over some processes, what we do once you're under contract, and then I'm going to go over vesting. Last time we did this, we had a lot of questions about vesting because I think a lot of people that have property or are on title properties with family members and so on want to know, can they sell the property? Who has to sign when they sell the property? Or they might want to join on the property with a family member that's elderly. So we're going to go over kind of the different vestings of the properties and how to do it properly, which is the deed preparation. But the process that we do mostly is the title process. When you go under contract with Melissa, you have to have an escrow agent, and that's what we are. We're the ones that are on the contract that hold the deposit. That once you sign the contract comes to us, and we do our services. Our services are lien searches, permit searches, code searches. So when you buy that property, you make sure there's nothing there from the prior owner that could affect you from selling the property, from you to get fines from the city, from you to get anything from the county, any fines, judgments, or liens against you that were not your responsibility from the prior owner. Our job is to make sure that those things do not apply to you. We have to make sure that we address those things before you buy the property and they're cleared. We also insure the property from any deed problems, any past owners of the property that want to make sure to make a claim on the property. We're in Florida. There's a lot of title fraud in Florida. There's a lot of real estate fraud in Florida. So we insure you to protect you from those issues on the property. So, we're going to go over a bunch of different scenarios as far as title of the property And let me start the slideshow for you guys. Hold on 1 second here. Tell me if you can see this here. Let's see. Where is it? You see it there?
We got it.
Okay, good. All right, let me see here. Okay. We're gonna go, the first thing I go over is deed issues or deed preparation, anything on your deed. There's gonna be questions on this as far as what to do with a deed. Tenants in common, joint tenants of right survivorship, tenants in entirety, life estates, limited liability companies, corporations, trusts, and probate. The one I'm going to go over the most is joint tenants of right survivorship. That is for people that have family members on their deeds that are uncle, a brother, a friend. If you have multiple family members on the deed of your property, you want to make sure that it says joint tenants of right survivorship. If something happens to one of those family members and they become deceased, your property has to go through the court system to be able to sell it. If you add the term joint tenants of right survivorship, the surviving person on the title gets the property without any court process, without anything that, it's a lot easier process to be able to sell the property. So we always recommend if you're buying the property with different entities as far as yourself, a family member, anyone like that that has ownership of the property with you, or you want them to have the property, when you're gone, you must make sure your deed says joint tenants of right survivorship. So that's something that is very left out constantly. When we have closings and you have a father and the sons on the deed with them, and they don't add these terms, they can't sell the property. They have to go through the probate process. They have to go through the court process. And it's very time consuming and very costly also. So these are things that when you do buy a property, or you are on the property with your deed onto a property, you have to make sure these are done correctly. And these things will save you a lot of time and money. So I want to make sure that you do see that. I'm not going to go much into to trusts because most people don't buy in the trust when it's retail. I don't know, Melissa, you see people buying a trust with your stuff? Not much, right? Like limited liability companies, if you're buying an investment property, we suggest you buy with a limited liability company. It's less risk for you unless, if something goes wrong with the property or something like that, it's not in your personal name, it's in the LLC. It's less exposure for you as a company when you buy. Let me go ahead. Those are vesting. Hold on 1 second here.
And I'll interject, as far as
whatever you want to do.
an LLC.
This is tenants in common. If you have more than one owner, it goes to the next owner as tenants in common. If you have rights to survivorship, it goes to the person that's alive, separate entities. Deceased owners, they'll pass to their heirs. If you have joint tenants of right survivorship, you will need probate. Okay, so there's different things on deeds with tenants in common. Let me go through here. Okay, this is the joint tenants of right survivorship. I want you to look at this real close here because this applies to most of the deeds in Florida. If you have a brother or sister, someone that owns a property right now, you want to make sure your deed is done correctly. If you have an aunt, an uncle, anyone like that that's leaving you their property when they're deceased, you want to make sure this is on the deed and your name is on the deed. So, if this is ownership, property, diversion, okay, so right survivorship must be established with joint tenants of right survivorship. So like I said, again, you have to have someone on the deed with you and it has to say joint tenants of right survivorship. So make sure if you have any questions with deeds and you want to know that you're protected without them not to go through probate when you're deceased, someone's deceased in the deed, you can send it to us, we can look at that for you. But these are the terms you have to see on it, okay? Go to the next one. All right, all right, I'm just trying to go through the ones that would make more sense with your buyers here. Mm-hmm. Okay, if you have an aunt or uncle or a father or something like that wants to pass the property on to you when you're deceased, you can do something called a ladybird deed, and these are also very good to have. They're used, commonly in Florida, so you can avoid the probate process also. So if you have any questions on that, that's called a ladybird deed. That's something where you can avoid the court process if someone's deceased. These are more for investment properties trusts. And then you have land trusts that people use when they buy a property. If they want to protect their name and not buy with their name, they use land trusts. But once again, when you're getting a mortgage, these are things that you cannot use as far as, these are more for investment properties. So let's see here. Revocable trust you want to use and revocable trust you want to use.
Can
Yeah.
you hear me?
I can hear you.
Okay, I just want to interject a little plug because I know that most of the people on this call are probably looking to purchase their own home. But for those that are looking for investment properties, we're going to be having another seminar next month focused on building your investment portfolio. So just keep an eye out for that. It's going to be very good. It's going to cover, you know, how best to hold title, like you were talking about LLC. Also, you know, just investment opportunities that, you know, purchasing commercial real estate, purchasing fix and flips, and all of that's going to be covered. So just keep an eye out for that.
All right. I want to go into more of just what we do once the contract is signed. You know, it's not on here, but we're the ones that you hand the escrow deposit to. We're the ones that make sure that, you know, that gets credited to you back at closing on your closing costs. So when there is a check, when you give the check to the realtor, the check comes to us, that gets credited to you back in the closing. We pull the lien searches, the title searches on the property, and then at the day of the closing, we're the ones that you sign the paperwork with. You sign the deed, you sign the mortgage packages, the closing disclosures, everything with us, and we're the ones that actually record the deed to your property and handle the process of dividing up the monies to the buyers, sellers, and realtors and mortgage entities. You have any question, Melissa?
No, that's
okay. I want to go into that, more of that. I'm trying to think what else would be helpful to them as far as the title process.
So no, that's great. I know that you did mention, I just want to make sure that everybody heard that you're instrumental in making sure everybody's worry is there a judgment on this property? Is there a
Right.
lien? And you do send out, your staff sends out a request directly to that city to see what might be on the property, any liens, any permit issues. All of that is what you guys make sure that if there's something on there, that it's going to be cleared up before closing.
Right. We're in Florida here. We have the lien search companies that we contact the liens every city, and what they do is we order a permit search, a code search, a water search. So when you're buying your property, there's nothing left behind from the old seller. So we have a lot of people that don't close out permits here in Florida. A lot of people that have violations on their properties, and those are things that when you're buying a property, you do not want to inherit those problems. So we do a detailed search in every property that is bought, making sure it's all perfect for when the new homeowner takes possession of the property. And that's the same with the title searches. You have to have a title search on the property, and that protects you from any judgments against the property, liens, any past owners that make claims to the property. These are key things that have to be taken care of before you take possession of the property, before your closing day. These are things that are done behind the scenes by what we do.
Right.
Yeah.
So when you get to the closing table, just know that, you know, title insurance, especially if you're doing financing, it's really mandatory because you don't want, you know, issues from the past to come haunt you on your property.
The lenders will not give you the loan without the lender's title insurance policy. So they're going to make sure that, you know, your title is clear on our end also. So they're double checking it with us. And by the time you get to that closing table, if you know, everything should be perfect for you, and you know permits, no liens, no judgments, everything is, so if you want to sell that property in the next month or 2 months or 3 months, you should have a perfect closing. Everything should be perfect for your property.
And I kind of froze a little bit, so I might have missed you saying this, but can you clarify what's the best way to hold title if you're a married couple compared to a single couple? Not a single couple, a single person compared to a couple that might just be together but not necessarily married.
Well, if you're a couple that's together but not married, and you're both buying the property together, you want to use what's called joint tenants or rights of survivorship. If you're not married, if you're married, you want to go with husband and wife.
Okay.
You know, and that way, the couple that's not married, if something happens to one of the couple, the other couple has possession of the property and doesn't, you know. But if you're married, husband and wife is how you want to go on.
Right, exactly. And so if one person dies, and it's a husband and wife, then, for example, if it's the husband that passed away, the wife takes
Takes full possession of the property. Right. Now, I'll give you some examples of deed issues. If you own a property and you are not married, you're a single woman, let's say, and you get married after you own the property, and there's your homestead property, and your new husband moves into the property. Now that new husband has marital rights to your property. So when you sell that property, that the new husband now has to sign off on the deed also. And I know it's confusing to people. Well, I bought this house when I was single. Why is he involved now? That's how it is. That's the homestead laws in Florida. So now they have marital rights to the property. So when you're buying a property as a single woman or man, and then you do get married after you buy the property, that new spouse has marital rights to the property. They're entitled to that property also.
Right. I think that's quite surprising for many people.
Yes, and I get that a lot. I get a lot of questions when we get to closing. Why does he have to sign? Or why does she have to sign? They have nothing to do with the property. That's how the homestead law works in Florida. They have marital rights to the property.
Or
So,
the other thing, and clarify if I'm wrong, if you have a property, and then you and your new husband buy another property as a homestead, you can turn that property that you owned before into an investment property, and then it's not the same rules, right?
Correct. It's your homestead property, right?
So
if you
yes.
bought that one, just by yourself, then that's how it is, right?
Exactly.
Correct.
So everybody
Yeah.
out there, you're thinking about getting married, think about buying a new house and turning that old property into an investment property.
Correct. Yeah. So those are a lot. We get that a lot at closing. We're tracking down, spouses and so on that they don't think they have anything to do with the property, but they do. The minute that they move into the property and it is your homestead property, a spouse, it becomes, a marital asset. So
I had that happen one time. We were at the closing table and the buyer didn't think that the husband mattered because he was over in Europe somewhere.
Right.
We all had to get up from the table because we had no way to find him. So that can cause problems.
And that's our biggest hurdle. That happens a lot. But usually where it works out at the end. So
exactly. Okay. So anything else that you have to share with us today, Mark?
Well, I can tell you where we're at with the industry right now, because we are right at the front lines here. We work with a lot of different buyers in this industry. People are buying and real estate's moving. We're getting new contracts in every day. Properties are not going down in value. If it's a good property and it sells fast. And so there is no dip in the market that we can see. It's still a good market, and I think it's going up. I think you're going to get more people buying from out of state that want to be here.
Exactly.
And I think it's just going to get, our market's just going to go up and up here. So if you are, this is a great time to buy. And I'm seeing it. It's not stopping, and it hasn't stopped. Our South Florida market is a very strong market. It's getting stronger. And I think this summer will be one of the strongest summers in real estate we're going to see in years, because we're going to have a lot of people. We're already seeing people coming from out of state here.
Yes.
So I think it's going to be a great time to buy here. I really do. And I can see our numbers supported already.
Awesome. Awesome. Well, thank you so much for sharing. And Maria, do we have any questions? Anybody have questions out there?
Oh, wait, I think one just came in.
Okay.
Oh, it's a funny question. Just so we can have a good laugh. James is asking, hello, Mark. How did you get a haircut during this quarantine?
I didn't. No haircut.
We're all struggling out here.
No, I need a haircut.
But no, we're good. No more questions.
Okay. So if you think of a question, participants, just plug it in. But in the meantime, Mark Bookstein kindly donated a gift card of $25 to one of the few places that's open right now, Home Depot. So we're going to see which lucky person gets the $25 Home Depot gift card. And that lucky person is Alnisha Phillips.
Alnisha. Are you here? Yep, Almisha looks like she's connected, but Almisha, can you say hello to us? There we go. She was on it.
Yay, yay, Almisha Phillips, congratulations. And congratulations to all that have won a gift card today. And you're all a winner because you're getting $500 towards your credit closing costs when you purchase your home. And I'm just so happy that you all were able to be here. Just go ahead and tap into the chat and let us know if this was helpful for you today, if you learned something. And for all of you that stayed until the end, we are making a note that you were faithful to the end. And I'm sure you learned something, but yes, let us know in the chat. And we will be sending, like I said, out an email on Monday with your voucher, with your handy guide regarding things to consider when buying your home, as well as all the contact information for all the panelists today. And feel free, reach out to us. We are doing free buyer consultations. Just keep in mind that when you purchase a home with us, you pay no commissions and no fees. So we are happy to kind of sit down with you, go through the plan, and guide you towards your goal of home ownership. And we would love to hear the feedback. Any questions that you have, feel free to email us and we'll be able to get the answers for you. Maria, do you have any other words that you'd like to say?
Yes, I am going to be sending a message to everybody through the chat with the email address. Please, in order to receive your voucher, your $500 closing cost credit voucher, send an email to the email address that I'm going to share. It's events@mmillergroup.com with all of your information, name, phone number, that's pretty much it, right? And your address, so that we can go ahead and send you your voucher. And also to the winners, Giovanni Ocasio, R. Thorpe, Jasmine Johnson, and Almisha. Make sure to send us your information, your address, so that we can mail you your gift card, or your email address so that we can electronically email it. I am going to write it right now.
You're going to type it into the chat?
Yes, I'm going to type it into the chat, and I'm going to share it with you all.
And yeah, so I mentioned a little while ago about the other events that we have coming up. We will be sure to notify you, and hopefully you can participate. We always try to keep it fun. We always have giveaways. And we just love being able to come to you with information. So the more questions and feedback we get, the better we can put these, especially virtual events. This is the way of the future now. So the more that we can offer to you as our service to you and making sure you have everything you need. So it's events@mmillergroup.com. And thank you again, guys, for being here. Thank you to my staff and to the panelists again. And that's it. Have a great weekend. Happy Mother's Day to
Yes.
all of you
Happy Mother's Day, everybody.
out there, and enjoy the day. If you have to go wave, drive by your mom and 6 feet away as much as possible. But happy Mother's Day to you all. Thank you so much again. And these, I see. What info do you need? Can you just repeat that again? Okay, you have that full name and contact information and address. And
Particularly the email.
I'm sorry?
Make sure they put the email.
The email address in there, yes. The gift cards, I believe, are coming by email. They're e-cards that are coming over to you. So thank you, Danny and Natalie.
Yes, you guys are here.
Yay.
Hi.
Our great clients. Good to see you guys. And with that, thank you again, guys. And we will be closing out right now. Have a great, great weekend. Bye-bye.